Welcome to Talk Tickers, where we cut through the noise of earnings season to get to the real story behind the numbers.
And today, we are diving deep into the communications platform 8x8. That's ticker EGHT. The stock absolutely surged after the bell, and it was all on the back of its second quarter results. This could be a really significant shift in how investors are thinking about this company. All right, so let's get into it. The market's reaction, that huge pop, it wasn't just about one number. No, it was driven by a clean, decisive beat on both revenue and earnings.
And you can see it right here. 8x8 delivered a really strong beat across the board. Revenue came in at $184.1 million, which was comfortably ahead of what analysts were expecting. And, maybe even more importantly, for a company that's so focused on profitability, their non-GAAP EPS of 9 cents, that also beat the 7-cent estimate. It was just a solid performance.
But, and this is so crucial, this beat didn't happen in a vacuum. You have to look at the context. This fantastic quarter comes after a brutal year for the stock, which was down 16%. During that same period, the broader software sector was up over 20%. That massive underperformance set a really low bar, which makes this beat a potential turning point for the stock.
So the big question is why? Why did they have such a good quarter? Well, it's not just luck. This is all rooted in a very deliberate strategic pivot they're making towards AI and a whole new go-to-market plan.
Management's story here is crystal clear. The CEO, Samuel Wilson, he was really hammering this home on the call. AI isn't just some bolt-on feature for them. They are weaving it into the very fabric of their entire platform. They see it as the fundamental driver for making customers more efficient and ultimately keeping them happy and loyal.
And this is a brilliant illustration of their new strategy in action. They are taking a page right out of the modern software playbook with a product-led growth motion. Think about it. They're giving away a high-value tool, workforce management, for free. The goal? Replace their biggest competitor, which is often just Microsoft Excel, drive deep adoption of their platform, and make their whole ecosystem incredibly sticky. That just sets them up perfectly for future upsell opportunities.
Okay, let's switch gears and look forward. We need to see how all this builds into their guidance for the future, because this is what sparked a really key debate on the investor call.
So, the company signaled some serious confidence by raising its full-year guidance across the board. They lifted their forecast for both revenue and earnings per share. That's them telling the market, hey, what you saw in Q2, that wasn't a fluke. We think this is sustainable.
But here's where the story gets a little more interesting, a little more nuanced. The guidance also pointed to lower gross margins for the rest of the year. And, as you can imagine, this immediately became the #1 thing analysts wanted to talk about during the Q&A.
And management's response really boils down to this classic strategy, trading percentage for dollars. So the worry from analysts is that this lower margin usage-based revenue from AI and APIs is growing way faster than their core subscriptions, and that's squeezing the overall margin percentage. But management's comeback is simple. They're saying, look, we're focused on growing absolute gross profit dollars and the total lifetime value of our customers. They actually see this as a healthy sign of engagement, a trade they are more than willing to make for long-term shareholder value.
So let's put it all together. What's our call on 8x8 from here? What should you be watching for ahead of their next earnings report?
Looking ahead, we're watching a few key things very closely. First, will that new free WFM tool actually drive the adoption they're hoping for? Second, can they keep growing that usage-based revenue, which is now almost 20% of their service revenue? That's huge. We'll also be looking for how they start to monetize these new AI features. And finally, can they keep executing on paying down debt? And can their international business keep growing faster than the super competitive US market?
So our call is outperform. This strategic pivot to a product-led growth model, combined with a really clear-eyed focus on growing profitable dollars instead of just chasing a margin percentage, well, that presents a totally credible path to a stock re-rating. If management keeps executing on this plan, we see a very plausible move toward that $3 to $350 range.
This is not financial advice.